Corporate finance practice problem using OneNote. Capital lease versus operating lease determination. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab, then down in the 1630 Capital Lease versus Operating Lease Determination tab. Also note, when using OneNote, look at the immersive reader. Our practice problems will be mirrored down in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, you have information up top. We're going to be doing the calculation in the blue areas. The question being, do we have a capital lease or operating lease? This is more of a financial statement reporting question. Oftentimes, the regulations, such as generally accepted accounting principles, will want a determination as to whether something has to be recorded, in essence, as in capital lease or operating lease. The question has to do with a situation where the form of the item is set up as a lease, but is it really in substance, in actuality, more like a purchase type of situation that has been set up in form of a lease? If it is, then the idea would be that we would want to put it on the books, on the balance sheet, as basically a situation where you put the asset on the books and then you put the related liability that would be there in a similar fashion as you would see in a purchase and financing situation, as opposed to if it's just a operating lease, a normal lease, an operating lease, you would simply just be expensing the items over, the time period that you would be paying it. So that's going to be the question. Now, in theory, that makes sense. Like, when would this happen? You'd say, well, if basically you're looking at the lease and you're saying it looks like really in substance what's happening is it's a purchase, that's when you'd want to do it. That's when you should put it on the books as the asset on the books and then the financing, the liability on the books. But when does that exactly happen? Any kind of law has to draw some kind of like arbitrary line to say if these things are met, that's when you have to report it there. So the arbitrary kind of rules that they got to put in place to say what level has to be cleared for that to happen would look something like this. I won't go over them exactly, but we'll take just to give it an idea of it. We would say, okay, well, if you basically are leasing this thing, but you're locked into the lease for the entire useful life of the property. So for example, if it's a 5-year useful life forklift, and you then are locked into the lease for the entire 5 years, and you've committed to being in it for the entire useful life of the property, it looks a lot like then you're actually purchasing it because you've committed to lease it for the entire useful life. Or another kind of one would be, well, if you present value the payments and you come up to something that's going to be basically equal to the actual purchase price if you were to purchase it, and you locked yourself into basically a lease that requires you to pay an amount that's going to be somewhat equivalent or close to the amount that you could purchase it for, then once again, it looks like you kind of locked into a sale type of situation in that case. And that second one is one that would take a present value calculation for us to determine. And that's why it's going to be something that could be useful here as we think about these capital kind of financing decisions. Now, again, this is something that you would think about with regards to our reporting purposes for the reporting of the financial statements. But from a finance perspective, when we're making decisions as to what type of leasing options and financing options we want, then we need to take that into consideration as well when we make our decision-making process. So, information. We got the lease. We're going to assume that we're going to be purchasing a piece of fixed asset that would have a purchase price of the $201,000. We're going to lease it, and we're committing to the 252 months in the lease. The asset has a life in years of 26 years. The minimum lease payments are going to be $2,000 per month. The discount rate that we're going to use will be the 11%. So let's first take a look at the lease period kind of percent. This would be the first test. We got the lease period in months we said was 252 months. Let's break that into years by dividing it by the 12 months. So the 252 divided by 12 would be the 21 years. So again, we just locked into the months. So the 252 divided by 12 is going to be the 21 years. Then we have the assets with a life of the 26. So the asset has a life of 26 years. So if I take the 21 years divided by the 26 to compare out, we have this for, 80% we've leased it for basically 80% of the useful life if we're committing to the 252, which is 21 years compared to the 26 years. So again, we have it for a substantial amount of the useful life there. And then that's going to be one test, of course, to see whether or not you think it looks more like a purchase, even though in substance it's going to be a lease. Then let's take a look at the present value of the lease payments. So if we have the monthly payments are going to be $2,000, we could think about the present value calculation, a couple different ways. First, we'll kind of break it down into a yearly payment and then apply our present value, and then we'll take a look at it applying the present value on a monthly basis. So for example, if we took the monthly payments and we said that the months are 12 months, then we have, a yearly amount that's going to be paid out at the $24,000. If we do that, that'll make our present value a little bit easier for us to deal with. So we could do our present value calculation. We're going to do the present value calculation in Excel here. If you want more practice with the present value calculations, including practicing them in calculating them in different ways, such as tables and uses of formulas, take a look at the prior section where we focus on that in detail. Here we'll just do the Excel calculation, and you can see it to the right. The present value, we would take the rate, which would be the discount rate. That's going to be the yearly rate, so that'll be easy to use. That's why we kind of broke this out on a yearly basis. Comma, number of periods is going to be the number of periods in years. We calculated up top to be 21 periods in years. And then comma, the payment amount, and we calculated the yearly payment to be that $24,000. So then we get that's going to be the $193,802. So the $193,802 compared to the $201, we'll see how close it is to the purchase price at this point in time. You could also do that calculation in months, so it would look something like this. Instead of us breaking it out to the yearly amount, we might then just use the monthly amount, and so we could say that would be the present value of the rate. So we'd pick up the rate would be the 11%, but that's the yearly rate. So if I divide by 12, then we get the monthly rate. And then comma, the number of periods in months then would be that amount of the 252 in terms of months. And then comma, and we'd have the payment amount in months, which would be the $2,000 per month. Gives us a slightly different number due to the fact that we, of course, had to group the monthly payments. And then when we did this present value, it present valued them all at the end of the period, in this case, the end of the year. This would present value at the end of the period, which would be the end of each month. So in any case, then we could do the calculation. We could say, okay, well, if we take that present value of the payments, I took the yearly one here, and then we compared that to the price of it, the current price, the 201. So now we're comparing the same thing to the same thing, apples to apples, as they say, in current unit dollars. And we could say then we have the 193,802 divided by the 201,000. That's 96.42% about, if we move the decimal place over. So that looks like it's pretty close to the price. So you would think then we would have to capitalize this or record it on as a capital lease as opposed to an operating lease, which means we'd have to put the asset in essence on the books as an asset, kind of like a fixed asset type of, in a similar fashion there, and then the liability in a similar way as if we were to finance it on the books at the liability. And another problem, we'll take a look at what the impact of that will be. You might start to think, well, there's no real net impact on the equity. Assets minus the liabilities will give us basically the same equity. But you could have an impact, of course, in some financial ratio calculations. So next time we'll take a look more at the impact in a future problem of what it might look in the reporting of the financial statements.